Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Guys, today we are going to discuss one very important area of your paper SBR. You see, one of the core objectives of your examiner in SBR is they want to test you if you really understand financial statements and the accounting standards and its application from investors' perspective or not. At the end of the day, you need to understand that whatever financial statements you prepare it for investors, right? Investors or potential investors are your key stakeholders. Make sense? And since they are your key stakeholders, they would want to really understand their financial statements and use those financial statements for their own benefit. That's the main objective. Now, often examiner provides you a certain requirement whereby your examiner asks you that why, for example, why providing a particular sort of provision would be beneficial for the investor. Why would creation of a provision would be beneficial for investor? Why would there be, why a disclosure for changes in accounting policies or estimates or prior period errors would be important for a shareholder? Why would it be? Why would sustainability related disclosures be important for investors? So whenever examiner asks you, these type of questions, your examiner wants to test if you understand the other side of the story or not. I've often seen this case that students, somehow ratify all the accounting standards. They know what IS 37 says, what IFRS 9 says, what IFRS 2 says, or maybe what IS 37 says, IS 38 says. But sometimes you do not really understand that why these standards are prepared in a manner or why they are prepared in the structure they are in. So you don't really get the purpose why something is available. Whatever accounting standards have been prepared have certainly be prepared have certainly been published and prepared keeping two things in mind. Do you remember the conceptual framework? Conceptual framework told you two fundamental characteristics of financial statements. Two fundamental characteristics of financial statements. All the information which is provided within your financial statements must be relevant, and all the relevant information must be faithfully represented. And why that must be done? Relevant information must be faithfully communicated to your investors in order to help them in their investment decision making. You see, consider your investor as a large public fund. Consider your investor as a large hedge fund. Consider your investor as a large institutional investor who invests a lot of money buying shares of your company. Now, that particular investor has a lot of companies available, has a lot of investment opportunities available, but that investor would decide to invest in your company. You see, that investor could have invested in real estate, that investor could have invested in digital assets, that investor could have invested in derivatives, that investor could have invested in bonds. But rather than investing in those type of instruments, your investor may decide to invest in shares. And when you talk about equity instruments, your company's equity instrument in particular. So your investor, a large public fund, a large hedge fund would need to allocate resources towards equity investment. And when they are doing so, they analyze the financial statement of different companies. They understand what's the underlying affairs, what's the underlying state of affairs of a business. And, the more transparent and the more clear information you provide to them, the better decision they can take. Do you understand? So examiner wants you to understand that whatever IAS and IFRS says for the benefit of investors at the end of the day, right? So for example, an examiner can ask you, for example, I remember in the attempt of May-June 2024, if I'm not wrong, there was a question whereby examiner asked you whether providing a disclosure of termination would be beneficial for investors or not. So you need to understand that if there is a restructuring going on, your investors would want to know what's the status of the restructuring, why that restructuring is happening, and if that restructuring is happening, when is going to be the cash outflow from the provisions that you have recognized against restructuring. You see, all the state of affairs your investors would want to know in order to make better investment decisions. Do you understand? Clear? So again, whenever examiner provides you, and I can assure you of this, please, you see, whenever you go into your exam, you really don't know what's going to come into your exam, right? But I can assure you, whenever you go into an SBR exam, most likely in question number 4 of your exam, you are, for some marks at the very least, you are going to be tested for this perspective. Your examiner will always ask you why something is being done and why would it be beneficial for investors. What information will you provide to your investors and how that information will help in the decision making of investors. Do you understand? That is the investor's perspective, right? So in the past few attempts, I've always seen that question number 4 always have 8 to 10 marks of investor's perspective embedded in that question. All right. The question is, sir, exactly what will my examiner ask in question number 4 regarding investor's perspective? We don't really know. We don't really know that which particular instance or which particular accounting standard your examiner is going to cover from the perspective of investor. We don't really know, right? But what we can do before our examination is we can do a lot of practice on, some questions. We can see wide array of questions. We can see wide array of scenarios whereby your examiner was asking you something about investor's perspective, and through this practice we'll be able to perform better in our real examinations in the upcoming attempt. All right. So from now on, from today's session, what I'm trying to do is that we'll be doing multiple past paper and we'll be doing multiple areas of your examination kit, whereby your examination kit has touched upon investor's perspective. Those are the type of question that will help us understand and that will enable us understand how to approach these type of questions. All right. So this particular session is the first session in which we are going to talk about investors' perspective. All right. Just give me a second, please. So as I was saying, we'll be doing multiple questions that will help us understand, that will enable us to answer better these type of questions. So the first question, actually a part of the question that we are going to see in today's session is with the name of Colat. Now, Colat is basically a past paper from March, June 2021. It's relatively, not a very new past paper, you can say. We have already attempted this part. We have already attempted this question Colat in our regular classes. But now what I'm going to do is I'm only going to attempt, or at least enable you to attempt, one part of this question, which is solely related to investors' perspective. All right. So let's focus on this question. It says that Colat company manufactures aluminum products and operates in a region that has suffered a natural disaster on 1st November 2007. There has been an increase in operating cost as the company had to replace a regional supplier with a more costly international supplier. You see, few years back, we as individuals, used to understand that anything which is related to climate is not related to us. Companies used to feel that if there is something going on with climate change, if there is something going on with global warming, it is only going to affect individuals. It is not going to affect corporations at large. But you see, this is one of the finest examples. This Colat company manufactures aluminum products, but the area in which it operates has suffered a natural disaster. Natural disaster could have been floods, natural disasters could have been earthquakes, or natural disasters could have been, some sort of torrential rains or heavy rains that could have led to flooding or anything else. So as a result of this climate change or a natural disaster, they had to switch towards an international supplier for their raw material. Because, for example, either the local suppliers were unable to supply the raw material on time due to the disaster, or their mines or their fields were destroyed, or they were unable to work, right? So they had to switch to a more expensive international supplier. Companies do get affected directly or indirectly due to climate change or unsustainable practices. The year end of Colat company is 31st December 2007. Now we are not doing the whole question, right? Okay. We are only doing one part of the question, and that is related to requirement number A. Examiner is asking you, investors need to understand a variety of factors when making investment decisions. I'll ask you, what factors do you think an investor, and when I talk about an investor, I'm talking about an individual, I'm talking about another company who invests in equity instruments of another entity, I'm talking about a bank who tends to invest in equity instruments of another entity, I'm talking about a hedge fund, I'm talking about a pension fund, I'm talking about a brokerage house, I'm talking about any institutional investor or venture capitalist. Just think in your mind what type of, whenever these type of investors are making their investment decision, what factors do come into their mind. I mean, they would take into account the financial reasons. If, are your gross profit or net profit margins in accordance with the industry average or not? They would take into account market growth. They would take into account raw material availability. But at the same time, nowadays, investors also take into account sustainable practices that have been adopted by the company. Because you see, nowadays, no company can say that we have no effect of climate change, we have no effect of unsustainable practices on our company. Directly or indirectly, your company is going to be affected. So what I'm trying, my point is that investors nowadays consider many points before making their investment decisions, and sustainability is one of them. All right. So your examiner is saying the nature of the companies in which they are looking to invest is an important consideration, as is the need to incorporate sustainability factors into investment decisions. Nowadays, investors are smart. Nowadays, investors are smart. If I remember clearly, the Central Bank of United States guided banks to only invest in equity instruments of those companies, who provide sustainability disclosures, or only to lend money to those companies who are certified to be sustainable companies, right? So any company who is trying to attract capital into their company would now need to satisfy their investors also regarding sustainable practices. So sustainability is one factor that investors nowadays factor out into their investment decisions. All right. Now, the requirement of your examiner is discuss. Discuss what? Discuss why sustainability has become an important aspect of the investor's analysis of companies. Now, the question is pretty clear. Can anybody tell me what's the question? Is your examiner literally asking you about IFRS S1 and S2? Give me your answer. Is the question about IFRS S1 or S2? Give me a yes or a no. No. This is a pure investor's perspective part for 4 marks. Your examiner is asking you why, for example, IFRS S1 and S2 would be important. Examiner is asking you why sustainability is an important factor for your investor. Why do you think that sustainability information must be provided to your investor so that he can, that investor can make a better decision? So it's all about why sustainability is important. Now, while you're writing your answer to propose the fact that sustainability information is important, you can talk about IFRS S1 and S2. But this requirement in particular is not solely about IFRS S1 and S2. You see, IFRS S1 and S2 only focuses on providing a disclosure. But the question here is why that disclosure is important, why that information provision is important. So you need to focus on the question why, right? Now, I know that you can write a very good answer, but what I have done is I have listed out some descriptive bullet points that you can read a couple of times and make your own answer. Remember, guys, in your examination, I'm not expecting you to write your answer in bullet points. That is not expected out of you. You can never have a discussion which enters into a bullet point phase, right? A discussion is always descriptive. Make sense? So you need to write in a paragraph form. But I understand that you as students would want some key points or some key starting terminologies or starting lines that you could use while drafting your answer. So what I've done, I've listed down some points and I'll be discussing these points with you. And these points, amalgamating these points, you can create a descriptive paragraph, right? So we earlier did our sustainability class on S1 and S2, and that was literally very much exhausting, right? A lot of information was provided to you. And you might be thinking, sir, how will this be tested in our examination? So this is one kind of an area for 4 marks that you can expect in your examination, and how to answer that, we are discussing that right now. All right. So some critical points that you can include in your answer. Why sustainability is important. You see, it's important for companies and their investors to do sustainable business. Gone are the days where sustainability or climate change or global warming was a niche name. Now it's a household name. Everybody knows about climate change. Everybody knows about unsustainable practices. Everybody is concerned about, let's say, pay equality or anti-racism. Everybody is considered about it. So there is a social impact of sustainable practices as well. Nowadays, investors and people, there are lobbies who discourage you from doing business which is regarding, for example, non-renewable fossil fuels, right? So there is a lot of public debate going on regarding sustainable practices, and that is why companies and investors both are mindful of sustainable practices, right? Investors, on the other hand, are concerned about how capital which is invested in the business is being utilized. You see, nowadays, since central bank is having a close eye on hedge funds, on all financial institutions, your central banks are keeping a close look on where and on which companies you are investing. The government, the regulators are constantly assessing companies and keeping a close eye on those companies who are doing unsustainable practices. And there is a very high likelihood that companies who engage in unsustainable practices will either be barred from doing business in future, or they will not have the access to capital. So investors tend to be mindful of this fact while they are investing in equity instruments of another entity. Let's say you as an investor invest a lot of money, millions or billions of dollars, in an entity which manufactures plastic bags. All of the investment that you have done might go into the trash in a couple of years, because regulators, central banks, governments, lobbies, all of them are keeping a close watch on such type of companies, and they are going to lose business in future. Make sense? All right. So that is why investors are concerned about how their capital is being utilized, because if the company continues to engage in unsustainable business practices and it is not transitioning towards a more sustainable business, most likely they are going to lose their money which they have invested in a particular company. Sustainability issues, including climate change, can have a significant and long lasting impact on companies' financial performance, right? Investors take sustainability information into account when evaluating a company's performance. Like I said, sustainability is one of the prime or one of the core areas that investors assess before really investing in a particular company. This approach can be viewed as a comprehensive investment strategy. You see, most of you guys would have studied the paper financial management, right? And during financial management, you might have studied a topic which is known as investment appraisal. And during investment appraisal, we have, multiple times we have studied that whenever you get a positive NPV, you invest in that project solely based on financial grounds. So From a very much capitalist mindset and from a very much narrow mindset, if a particular investment is having positive NPV, it's supposed to be a good investment. But you see, any positive NPV is based on judgments that the market that you're investing in is going to grow, that the revenue is going to grow. And as the revenue grows, you are going to earn a positive NPV out of the project. Now, investors are mindful. They know that there are certain things known as sustainable development goals or SDGs, which have been unanimously accepted by most of the countries of the world. And United Nations and their respective committees are keeping a close eye on those companies who are adversely contributing to the global environment. And that is why they think that if they invest in companies which, although they have positive NPV projects available to them, but the regulator may bar them from doing further business or investing further into their business, or may bar them from selling a particular type of product. Investors are mindful that all of their positive NPV projects can turn into a negative NPV project. So now what investors do? Not only are they looking on the quality of the management before investing, not only are they looking on the financials, not only are they looking on the market terms, not only are they looking on political, economical, social, and technological things, but they are also looking at sustainable factors before they really make an investment decision. Because all those positive NPV projects could soon turn into a negative NPV project if the business itself is unsustainable, right? So, this is a more comprehensive investment strategy adopted by investors that considers broader societal impacts of the decisions that investors make. Seriously, investors want to understand whether there are material risks and opportunities regarding sustainability issues. If you remember, the core objective of IFRS S1 and S2 was to provide disclosure on material risks and opportunities. Do you remember? All those material risks and opportunities that are associated with a particular entity, those material risks and opportunities are going to be disclosed according to IFRS S1 and S2, right? So investors want to know the risks and opportunities associated with sustainable practices, and IFRS S1 and S2 helps that. For you, it's very important to understand that effect on company of sustainability issues can vary from industry to industry and sector to sector. Please try to understand. Whenever an investor is analyzing which company is sustainable and which company is not sustainable, remember the impact of sustainability could vary from industry to industry. For example, let's say the teaching industry is less affected from unsustainable practices or is less affected through by climate change. But there are certain industries that are more exposed to the effects of climate change, right? So for example, companies who are in agricultural business, companies who are in fishing business, companies who are in tourism business are more affected because of climate change. So they might have more risks and some opportunities available to them with regards to sustainability. On the other hand, if you talk about my business or my teaching services, I don't have many risks associated with sustainability. I'm already sustainable. That's why I'm online. And number two, I also, at the same time, I have less opportunities with respect to sustainability. For example, I cannot say that my teaching services are sustainable and any other person who is teaching in this whole world is unsustainable. You see, I'm less affected. Make sense? So it's important for investors to understand that the risks and opportunities on sustainability vary from industry to industry and sector to sector. So if an investor is comparing two different companies from different industries or different sectors, that comparison may not be like with like. That's not a legit comparison. But within the same industry or same sector, investors can make their decisions to not to invest in such companies that are more exposed to unsustainable practices. The point that I'm trying to make is, yes, the risks and opportunities for, let's say, fishing industries and for teaching industries are different, right? But any investor who is investing in the fishing sector or fishing industry may then assess whether to invest in company A is better or company B is better. Let me create a scenario in front of you. Let's say there is one hedge fund who wants to invest in the fishing sector in order to diversify its portfolio. That hedge fund has two options available, option A and option B. Option A is a company with origins from, let's say, USA, right? They follow, they provide sustainability disclosures, right? They they get their sustainability audits done. And then there is another company. Let's say the origin of that company is, let's say, Pakistan. Such a company does not believe in sustainability disclosures, no sustainability disclosures, right? They do not go through any sustainability audits. What do you think, in which in company your hedge fund is going to invest in? Which company hedge fund is going to invest in? And provided, mind you, every investor is nowadays considering, factoring out sustainability impacts while making their investment decisions. Which company will this hedge fund invest in? Will they invest in company A or company B? Now, there could be a scenario that maybe that Pakistani company is more profitable in terms of ROI as compared to the US company. They have higher costs. Pakistani company has lower cost. So in terms of ROI, this company may be more profitable, US company may be less profitable, but eventually the hedge fund may decide to invest in company A rather than company B because company A is less exposed to unsustainable practices as compared to company B. Make sense? Do you understand what I'm trying to say? So, company A is going to have larger or greater access to capital. They can expand their business more successfully. They can expand their business more flexibly and more freely. While company B, who tends to be a more profitable business in terms of ROI, will always have lack of access to capital. They won't be able to grow beyond a certain limit, and that is how they won't be able to maximize their shareholders' wealth. So at the end of the day, companies who do not follow sustainable practices will always have lack of access to capital. That's the point I'm trying to make. Understood? So believe you me, often students always ask me, sir, can you tell us what do you expect that your examiner is going to ask us in this particular attempt? I'm telling you, something is going to come regarding sustainability, and this time whatever comes regarding sustainability, it is going to come from an investor's perspective. Now, it could be a scenario built up, it could be a closely descriptive question, but it could be anything which combines these two areas, investor focus and sustainability. These two things are going to be combined, and there is going to be a question about it. Do you understand? Let me know if everybody understands about this. Is this clear? So I have given you just certain points which you can read afterwards. I am going to provide you these notes, obviously, like I always do. And these type of bullet points you can easily remember and make an answer, from these while going into your examination. Maybe if you read these type of points 3 or 4 times before going into your exam, you'll remember these, and these will certainly help you in, drafting your answer. Certainly, there is going to be a question on this. All right. I am also going to touch upon another question of your Kaplan examination kit. And I would say this question, Margi, is an extended version of the previous question. Or rather, maybe a question which is on sustainability, but entirely from a different perspective, right? So, although this particular question will also address sustainability issues, but technically, it is not uh, you know, it's not the same as the previous question. Make sense? So let's go about it. All right. And I'm very sure that this question will help you understand a lot of topics for sure regarding sustainability. So we are only going to do the B part of the question, Margi. Again, Margi is a real past paper, but your examination kit has amended this past paper to include at least a 7-mark area, which is solely based on today's focus area, which is sustainability. All right, let's read it out. The directors of Margi have heard that they must implement the new ISSB standards. I'll read it again, please focus. The directors of Margi have heard that they must implement the new ISSB standards. ISSB, International Sustainability Standards Board, just like IASB, International Accounting Standards Board. So Margi understands that ISSB has developed new standards that must be followed by each and every entity. And you guys know what are those standards which have been published by ISSB? If I may ask you, what are those standards? IFRS S1 and IFRS S2. Make sense? The directors are aware that there are two new IFRS sustainability disclosure standards, also known as the ISB standards, but need advice as to what the standards consist of and how to comply with them. So they are basically trying to ask you what is there in S1 and S2, what type of disclosure S1 and S2 requires. Does anybody remember what was required under S1 and S2? If you remember it correctly, there were four pillars. There were four main headings according to which you had to provide your disclosure. Remember? So one was about strategy, one was about related to risk management, one was related to metrics and targets, and one I'm forgetting. So there are four particular areas that you had to focus on while providing your disclosure. So they are asking you, they need advice, what is IFRS S1 and S2 all about, and how do you comply with them, right? The directors of Margi would like guidance as to the advantages and disadvantages of complying with ISSB standards and are worried about how compliance will be perceived by investors. Let me give you a brief recall. If you remember correctly, ISSB was introduced, ISSB standards were introduced in order to harmonize the sustainability disclosure standards. The ISSB is not the first one to provide sustainability disclosures. Please, there are multiple bodies. There are multiple bodies in this world who have been promoting the disclosure of sustainable practices. There was SASB, there was GRI integrated reporting. There were many bodies who were providing the formats for disclosures to different entities. Some companies used to follow a particular type of disclosure. Other companies used to follow a different type of disclosure. So there was lack of comparability and consistency regarding disclosures. And that is why ISSB, a sub-body of, of IASC, International Accounting Standards, ISB, International Accounting Standards Board, and they provided for a forum and for a body who is going to harmonize the disclosure standards. Clear? In order to make sure that everything is streamlined across the globe. Margi also have operations in the Republic of Ireland. The directors are aware that any sustainability disclosures relating to these operations will have to comply with the European Sustainability Reporting Standards, ESRS. As I told you, there are multiple bodies who are asking you to provide disclosures on sustainability. So SASB, GRI, ESRS, multiple bodies are there. All right. So what's the requirement? The requirement is you need to provide advice to directors of Margi that addresses the following. So there are three key addresses that you need to make for 7 marks. Number one, what the ISSB standards consist of. What do you mean by ISSB standards? ISSB standards consist of S1 and S2. Why are there ISSB standards available? What's the objective of ISSB standards? They are asking you about that. What is required to comply with them? The 4 key pillars for which you have to provide disclosure. 3 of them I just mentioned, one I am forgetting still, right? So 4 key pillars of disclosure you need to provide. Highlight any misconceptions that are held by directors. So requirement number 1 is all about 3 things. First, what are ISSB standards all about? Second, how do you comply with them? I mean, what is required by S1 and S2 in order to comply with them? And are there any misconception of directors in the case that you have read above, right? So 3 things that you have to answer. And most likely this is the most this is the part of the question which will contain most of the marks. Although in this particular examination, this particular question, examiner has not bifurcated marks for each individual subpart, but still I think this would easily be of 4 marks or maybe 3 marks at the very least. So 3 to 4 marks, right? Out of 7 marks. So let's focus on this. What the ISSB standards consist of, the first part, right? You see, ISSB has introduced 2 sustainability standards, IFRS S1 and S2, with the aim of harmonizing disclosure standards on sustainability. Guys, this can be an opening line in your answer. This is an opening line. Whenever I've always seen students always struggle to start the answer. And once they start the answer, they can write a whole story about it. I am confident that nobody can stop you once you have started writing the answer. You know, the police will come and tell you, oh, please stop, the time is over. But you keep on writing. But I also know that first line is always difficult for students. They tend to spend so much time on starting the answer. I've just given you a starting line. You can ratify it just to make sure that you give a quick start to your oral answer. What do these consist of? These standards are supposed to act as a comprehensive global baseline for disclosures. Remember, countries in each individual country of the world are encouraged to have their own sustainability standards. But when they are developing their own sustainability standards, they can have a global baseline. And ISSB's S1 and S2 tends to act as a global baseline. And I'll let you know why is this important. You see, when International Accounting Standards Board in its earlier days published some ISSB said that whatever country is developing their gaps, generally accepted accounting principles, or any country who is developing their local accounting standards, please listen to me very carefully. When initially international accounting standards were published, ISB was of the opinion that any country who is willing to develop their national accounting standards can refer to IAS while developing their own accounting standards. Companies used to refer to international accounting standards, countries used to refer to IAS while they were writing their national accounting standards. But as the games moved on, majority of the countries realized that these international accounting standards are perfect even for their environment. So why should they be writing their own accounting standards? Why can't they really adopt the international version of accounting standards into their own country as well? Likewise, for example, in Pakistan, the Companies Act 2017, the law, the local gap here says that you follow IS and IFRS. So there is a local law which provides for accounting and presentation, but that law says that follow IS and IFRS. You see? So ISSB at this point in time says that we just provide you a global baseline for setting your own disclosures. But we know that if these disclosures, these standards are picture perfect, countries will not spare the effort of developing their own their own sustainability disclosure standards. Rather, they will adopt S1 and S2 naturally. All right. aim is to have consistent and comparable disclosures. Again, I told you that different companies used to follow different formats, different standards for providing sustainability disclosures. The objective of ISSB standards is to improve, enhance consistency and comparability in disclosures by providing a global baseline, right? The idea is to provide information that is material to investors, right? Examiner also asks you what could be done, what is to be done what is required to comply with these standards, and highlight any misconception held by directors. You see, you guys did not notice, but there was a misconception of directors in this particular question. And I can take back to you towards the question. Here, your examiner said that directors of Margi have heard that they must implement the new ISSB standards. Remember, the application of ISSB standards is voluntary, not mandatory. You see, ISSB is not a global government. It cannot dictate any country or any company in a particular country to mandatorily follow ISSB standards. No, they don't have the mandate. They don't have the mandate. They only can provide you, they can only encourage you to provide sustainability disclosures. Directors were of the opinion that they must comply with these standards. There is no must compliance of these standards. This is only voluntary application, not mandatory application. All right. So misconception of directors is that Margi must comply with sustainability standards. ISSB does not have the right to mandate application. Remember, local law will prevail. If local law says you need to follow ISSB, then that's a different story. But ISSB in itself cannot provide for the fact that you must follow our disclosure standards. That ISSB cannot do, right? So IFRS S1 focuses on disclosure of sustainability related risks and opportunities that are relevant to the company. One very important point for you to understand is that only those risks and opportunities that are relevant to the company are to be reported. That means that risks and opportunities that are not relevant to the company are not required to be disclosed as per IFRS S1. Remember, your ISSB or IFRS S1 is not asking you to report all sustainability risks and opportunities that are there in this world. No, only those related relevant risks and opportunities that are relevant to the company. So for some companies in some industries, the sustainability disclosure might be too lengthy. But for example, if I were to provide a sustainability disclosure, it will be a too small disclosure because I don't have any material risks and opportunities that are associated with my business. And I'm not supposed to report any risk or opportunities that is not concerned with me. All right. IFRS S2 focuses specifically, as far as S2 is concerned, it focuses on specifically on climate related risks. And when we talk about climate related risks, we talk about both physical and transitional risks and opportunities, right? Both standards use 4 key metrics. And now I remember: governance, strategy, risk management, and metrics and targets. So governance, strategy, risk management, and metrics and targets are 4 pillars under IFRS S1 and S2, according to which the disclosure has to be made. So these are some of the key points that you can use while explaining to someone what ISSB standards are all about. Are they mandated? No, they are not mandated. What is required to be disclosed in order to comply with S1 and S2? You need to disclose 4 things, right? You need to disclose only those material risks and opportunities that are related to the company. IFRS S1 talks about sustainability. IFRS S2 specifically talks about climate related risks. All good? Do you understand? Is it okay to everyone? Please let me know. So what I've tried to do is I've tried to shorten up my slides on sustainability S1 and S2 and provide you a shorten up answer so that you can refer to it and make very good use of it. All right. Let's go towards the second requirement. The second requirement is You need to tell the advantages and disadvantages of complying with ISSB standards for the investors of marquee. One very important requirement. You see, we just discussed that there was misconception of directors that ISSB standards must be complied with. But okay, there is no must requirement. But if the company, decides to follow S1 and S2, what could be the advantages of it? And at the same time, there could be some disadvantages as well. So examiner is literally asking you some advantages and disadvantages of complying with ISSB standards. Now let's discuss the advantages and disadvantages. I've just made sure that, I stay brief with it. So some of the advantages and disadvantages could be as follows. Number one, it can improve comparability. You see, companies do tend to provide sustainability disclosures, but if everyone follows S1 and S2, at least there will be more, that will improve comparability and consistency, and help your investors, right? One of the other advantages could be use of uniform language and terminologies. Since you are following S1 and S2, if everyone follows S1 and S2, it will provide greater transparency, and greater transparency can lead towards greater access to capital and investment. And I just explained to you in my last question that companies who do not take sustainability seriously will never have greater access to capital and investment nowadays, because investors tend to factor out sustainability as one of those factors while making their investment decisions, right? You know, one of the advantages of using ISSB's S1 and S2 is that it is also synced with other standards like those provided with SASB or provided by SASB or GRI. We discussed in our sustainability classes that IFRS S1 and S2 has picked up the best things of all available bodies and amalgamated them into their own standards, right? So the best of everything is synced into S1 and S2. While there are some advantages to investors and company of providing disclosures according to IFRS S1 and S2, at the same time, there are some disadvantages as well. Remember, any company who wishes to provide sustainability disclosures will incur a lot of costs. So it's costly. For example, you will have to dedicate headcounts on this practice. You will have to spend a lot of money collecting data regarding sustainable practices. Carbon dioxide emission, emission level 1, emission level 2, emission level 3. A lot of money would have to be spent on collecting data regarding to sustainability. And not only sustainability of your company, but your suppliers, your customers, the direct climate change effects or the indirect climate change effects, all the data relating to the risks, physical risks and transitional related risks will have to be documented. So you will have to incur a lot of cost in order to collect this type of data. And again, once you collect the data, you will have to have dedicated headcounts who report this data, and then you will have to enter into assurance engagements in order to validate the data that you're providing as part of your financial statements, right? So a lot of cost has to be incurred. Then remember, since there is no mandatory audit requirement or sustainability reports, therefore these type of reports are prone to emissions or biasness. So a higher degree of management judgment comes into the play while you are providing sustainability disclosures. An auditor can always question management judgment, as far as the accounting is concerned. But since there is no mandatory audit requirement of sustainability reports in most of the jurisdictions at this point in time, therefore a lot of biasness and omissions could be there in sustainability disclosures. That's the bad part of it. So investors cannot literally blindly rely on whatever you report in the sustainability disclosure. All right, this is one of the disadvantages. Let's go towards the third and the last requirement. Your examiner asking you what is the difference between ISSB standards and ESRS, European Sustainability Reporting Standards. There is written in your examinable documents that at least SBR students, both international and UK variant students, should know the difference between ISSB standards and European standards. European standards are referred here most likely because that European standards on on sustainability are one of the most you can say well developed standards. Or if you take European Union as one of the bigger markets of the world, many companies are mandated to follow ESRS, and that's why there is more focus on the understanding of ESRS as compared to other types of disclosures that are available. So as far as this part is concerned, you just need to know the differences between ISSB and European sustainability reporting standards. What are the differences? I've just documented a few, and these are more than enough, right? First of all, the ISSB standards, as far as the application of them are concerned, ISSB standards are not mandatory. But European sustainability reporting standards are mandatory for some companies. Sir, what do you mean by some companies? These are all public listed large companies. Any public listed large company which is doing business in Europe or has a business in Europe must follow ESRS. So there is no mandatory application requirement for ISSB, but ESRS must be followed by all European entities. There is a difference. As far as the scope is concerned, ISSB is suitable for all profit-oriented and public sector entities, but ESRS is only suitable for defined entities. Now, you do not need to know what are those defined entities. Defined entities, include publicly listed large companies. So ESRS are sincerely and primarily made for large public listed companies. They are not made for small profit oriented entities. But IFRS S1 and S2 are made for all entities, all profit oriented entities, right? So there is a clear difference between these two standards. The materiality approach, ISSB focuses on financial materiality, whereas ESRS focuses on, some mandatory disclosures. You see, I just told you that according to IFRS S1 and S2, you need to provide disclosure of all material risks and opportunities that are related to your company. But according to ESRS, there are some mandatory disclosures which are mandated upon all large publicly listed companies in the Europe. These type of disclosures must be provided, irrespective if those scenarios are related to you or not. And then there is a certain level of leverage, which in which case you only provide a disclosure when the issue is material, right? So this is one difference between ISSB standards and ESRS. And then there is, for example, where the disclosure would be provided. What is the location in the report? So ISSB has provided no specific prescribed approach. ISSB has said that ISSB disclosures will be a part of your general purpose financial statements, but where they will be disclosed? Will they be disclosed after accounting disclosures, or will they be disclosed before the financial statements? The location is not defined, not prescribed under ISSB. They will be part of your general purpose financial statements, but where they will be reported, towards the end, towards the start, towards the middle, that's not clarified. But ESRS has a prescribed structure with corporate reports. So there is a given structure, prescribed for European companies, and they must comply with that structure and defined approach mandatorily, right? So guys, let me know your feedback. Do you understand all of what we have discussed right now? This is very important knowledge, by the way. Very important knowledge, by the way. Right? So do you guys think that this type of an answer or this type of a handout will certainly ease up the whole, you can say the whole tension that comes into your mind regarding sustainability? I think, a bit of this handout will certainly help you in providing for a more descriptive answer in your examination. It's a shorter version of whatever you studied in S1 and S2. Agreed? Agreed, guys? Definitely, yes.